Hello all. Today the topic is accounting concepts. According to me, this is very important part of the accounting process. If someone wants to be a master in accounts, you should first have a sound knowledge in accounting concepts. Accounting concepts are backbone of the accounting process. When I start a batch of CA foundation and whenever I meet 11th and 12th standard commerce children, I used to ask them a very basic level of questions like why opening stock and the closing stock they are showing in trading account even though it is an asset, and asset should present in the balance sheet by why they are showing in the trading account. Trading account is actually nominal account where we should show only expenses and income, whereas you know that opening stock and closing stock is an asset. Like that, why depreciation is charging on the fixed asset? Why can't be directly we show the cost of the fixed asset in the profit and loss account? Again, why there's a difference between capital and revenue expenditure? Why we should divide like that? Why can't we mix everything and show as expenditure in the profit and loss account? Like that, many questions I used to ask. Few more examples. Who introduced capital account? How this capital account came into the picture? Why it became a liability? Same way, who introduced drawings account? Why it became an asset? Why can't it be a income? Like that, I used to ask a lot of questions. So students like wondering and they were like blinking their eyes, and they were thinking these type of questions not asked in the exam. How you are asking? How to answer this? Again, I started asking few more silly questions like why you are bringing last year closing balance as a opening balance for the current year, and why you are balancing ledgers at the end of the year and finding the closing balance. So like that, very basic level, common sense way I used to ask questions with the children. They were like they couldn't find the answers. Then I slowly given the importance of the accounting concepts. The biggest mistake happens is the accounting concepts we normally study in 11th standard as a part of the theory, and for the 2 marks or 3 marks questions, and we just read the paragraph whatever is given at the school level, and then we focus for the marks. But when you step into the higher end studies like professional courses like chartered accountants, cost and company secretaryship, even UG and PG, when we deal with high end topics, complex topics, big chapters, when you look into the background of those chapters, the entire chapters fully depend on few accounting concepts. Now, let's get into the accounting concepts in detail and see what are the accounting concepts are available and how to understand each concept and then connect that to our practical application of the accounts. Accounting concepts are basic rules, principles, and assumptions that we follow in doing accounting process and preparation of the financial statements. There are so many accounting concepts, principles are there. And in this video, I am going to cover few important accounting concepts like periodicity concept, matching concept, prudence concept, accrual concept, business entity concepts. Like this, few important accounting concepts I am going to cover. Now let's take first one, periodicity concept. If you read just like periodicity concept means this define the accounting year and it tells the accounting year 12 months, then you will not appreciate the practical implication of the accounting process. We have to go into very deep into the accounting concept. Now, I already told you that few questions I used to ask the children why we are bringing last year closing balance as a opening, and why end of the year we are closing the books of accounts and finding the closing balance, and throughout the year we are doing accounting and a lot of journal entries, ledger preparation we are doing it, and this year closing balance again we are carrying forward. What will happen if there is no periodicity concept? So first of all, let's understand what you mean by periodicity concept, then we will see if no periodicity concept, what would be the accounting process and its implications. First of all, in a very simple way, in a basic level, account periodicity concept is nothing but the concept which defines the accounting year. So we are following an accounting year in India from 1st April to 31st March. It's also called a financial year. So within the accounting year, it's a period of 12 months. Just like how few countries follow the calendar year Jan to December, in India we follow April to March. It starts from 1st April and ends on 31st March. So the periodicity concept defines accounting year at 12 months, and it basically says that everything should be accounted within the 12 months. So year starts with 1st April, ends on 31st March. Then this concept says everything should be accounted within the 12 months. Anything beyond 31st March should start with the another a new accounting year. So that's the reason we are closing the books of accounts by 31st March, and this closing balance we carry forward to the next year, like that previous year closing balance we bring as opening balance for the current year. Now imagine if there is no periodicity concept, what we do is we simply pass the journal entries and prepare the ledgers. So we keep on pass journal entry and then post the ledger. This we do till end of the closure of the business. So we don't normally close the ledgers, we don't find the closing balance. So there is no question of preparing the trial balance and preparation of the financial statements. We can't find the results of the business. So periodicity concept is actually helping us to close the books of accounts every end of the year, and taking that closing balance, and then we are knowing the results of the business and also the financial position of the business. If you don't do this, what will happen? We will not come to know the results of the business. We will come to know only at the end of the life of the business. Say a business is closed after 25 years, then only you will come to know. So that is not the way. We have to evaluate the performance of the business every period ended. So that period is a 12 months, and that is defined by a periodicity concept. Like how in school we write so many unit tests, quarterly, pre-quarterly, half year, like that, and then we will come to know the results of our preparation. Same way business also should evaluate its performance results at the end of every accounting year. That's the reason the accounting year came into picture. If no accounting year, there won't be a opening balance and closing balances. There won't be a trading P&L balance sheet. All these things you have to understand based on the periodicity concept. Now, whenever you prepare something, you have to raise a question: why we are doing this? Who told to do this? What made us to do like this? So that is the reason I'm here to explain you accounting concepts, practical implications, and its application into the real life accounting process. Let's come to the second accounting concept called business entity concept. So now I used to ask students how this capital account drawings account came into picture. Why capital become a liability to the business and why drawings become an asset. Now the students, they used to say, okay, it's a capital, it's a liability, and drawings is asset. With drawings will deduct from the capital. It is that's how the people taught in the school, and we followed the format. It's not like that. You have to think everything from the business perspective, and pass the journal entry and prepare whatever you do in accounting from the business side. Now what happens? So let's take X is a proprietor. He started his own business and he introduced a capital of rupees 1 lakh. If not the proprietor introduced, business would have been borrowed from somebody else. Like this 1 lakh, the business borrowed from a bank, then this amount we should return it back. It is an obligation to us. Any money that we received, which we should return it back, it's an obligation, it is a liability. Same way here, the owner is introducing the capital. He is the owner of the business, and he is the one who started the business, and he brought the capital inside. Now what happens over a period of time, when he runs the business, whatever profits he earned, whenever he need money for the personal purpose, he can withdraw that money for his personal use, not for the business use. He can take the money for the personal use. Now let's take an example. He introduced 1 lakh, and 4 years he run the business. Last 4 years he earned a profit of 4 lakhs. Now total amount of 5 lakhs is there in the business. In that he withdrawn 3 lakhs. Now the balance amount in the business is only 2 lakhs. Now what happens? The business is getting closed now. At the end of the 5th year, the business is getting closed. Now can a business ask the owner to return that 3 lakhs what he withdrawn, or can a owner ask the business to give back the 1 lakh capital he introduced? If this is not happening, what will happen? Owner can take money whatever he wants, and then he can use for any purpose. Then there won't be any difference between business transaction, personal transaction. There won't be any control on the personal transactions. That's the reason they introduced a concept called business entity concept, where business and owner separate parties. Both are not the same. So what happens? Just like a third party, how we borrow money and then repay, here from the business perspective, owner, even if it is a sole proprietorship, still the owner is a third party. So when business borrow money from third party, then the business has to return back money to them. That's the reason capital introduced is a liability to the business. At the same time, whenever owner takes the money from the business, like by way of drawings, then it's a rights of the business to get back that money. When you've given and there is a right to receive that money back, it is your asset. That's the reason the drawings become an asset. So because of the business entity concept, this capital and the drawings got introduced, and from business side, capital is a liability and drawings is an asset. Now let's move to the another concept called matching concept. I used to ask students like why opening stock and closing stock. As I said earlier, we all know that opening stock and closing stock is an asset. But still, why this is showing in a trading account, whereas trading is a nominal account. In nominal account, we should show only expenses and income. Like that, again, one more question I used to ask, why whenever you purchase a fixed asset, we are treating that as a capital expenditure and showing in the balance sheet as asset, not as expenditure in the profit and loss account. Wherever you incur certain revenue expenditure, we are showing in the profit and loss account. Why the difference came? Why can't we show both capital and revenue expenditure in the profit and loss account? Like that, I used to ask a lot of practical questions. Students couldn't answer because they didn't appreciate the concepts in the school level. That's the reason they are not understanding the practical implication of the accounting concepts. Let me now connect the matching concept to the questions whatever I raised. Here, the matching concept actually matching the expenses and income. It's matching expenses and income, but here two important conditions we have to follow. When you match expense income, both should be relevant. Relevant means because of this expense incurred, you are getting this income, or to get this income, you incur this expenditure. Both the way the same. So both should be relevant. Second important condition, as per the periodicity concept, both expenses and income should belong to the same accounting year. That is very important. Both should belong to a same accounting year. So now what happens based on this concept? Let's take an example. I'm running a coaching institute where I purchased furniture in the year 2019. So that is expenditure for me actually. But this furniture I'm going to use for 5 years in the future. So expenditure incurred in the year 2019, whereas income from this asset I'm going to get 5 years. Expenditure in 2019, income for 5 years. Matching concept says match the expenditure with the income provided both are same accounting year. But whereas here expenditure in 1 year, income in 5 years, so we have to match this expenditure with the 5 years. That's the reason this capital expenditure we don't show in the immediately in the year in which it is incurred as expenditure. Instead of that, we treat this as an asset and show in the balance sheet and slowly charge depreciation in every year in order to match the income from that particular asset. So important reason for charging depreciation is the matching concept. But when I ask students why we are charging depreciation, they tell because of usage of asset, passage of asset, obsolescence of technology. Those and all, it's a small kids used to say that way. Whenever someone is asking you why depreciation and amortization, you have to tell as per the matching concept, we are matching the expense with the income of that asset over a period of time. Same way you can also deal with deferred revenue expenditure. So there are so many items in the financial statements are actually prepared and presented as per the matching concept. Let me give you one more example for matching concept. As I said earlier, opening stock and closing stock both are asset, but we are showing in trading account. Why it is so? I'm going to give logic as per the matching concept. Now, what happens? Matching concept saying expense income should be matched provided both are relevant and both belongs to the same accounting year. If income in 1 year and expenditure in the more than 1 year, then we should match in the subsequent years, not in the same year. Now, let's take opening stock and closing stock. Actually, this year opening stock is nothing but last year closing stock. Last year closing stock means it is not sold, unsold stock. So the revenue is not recognized in the last year. So we have to deduct from the total expenditure. Like I'll give you a best example. I purchased in the last year 1 lakh rupee stock. In that I sold 80,000 rupees stock. So 20,000 rupees stock is not sold. If I compare generally people think that in trading account, closing stock we present on the credit side. So total debits and total credits including closing stock they'll total, and then they'll see difference take as a gross profit. And so that by this way people are treating closing stock is also part of the income. Actually closing stock is not an income. As per the matching concept, here you purchased total stock for rupees 1 lakh, but you sold only 80,000 of the stock. So the income here is only to the extent 80,000 of the stock. So to that extent, we have to match the expenditure. So now how much stock is not realized as an income, that much we should not treat as an expenditure. So from this total expenditure, to the extent stock not sold, not treated as income in this year, to that extent expenditure we have to remove. So in order to remove the expenditure from the total purchase, we are showing the unsold stock on the credit side. We can also show on the debit side from the purchase less the stock not sold, but we are showing on the credit side as closing stock, and this is not an income. We are just deducting from the total cost. So if you see the gross profit is equal to sales minus cost of goods sold. Cost of goods sold is nothing but opening stock, purchase, and all direct expenses. From this you will deduct the closing stock. So it's actually deducting from the cost. The reason why we are deducting from the cost is to that extent stock is not sold, not revenue. Now okay, so last year closing stock you understood it is not sold, so we have to deduct from the expenditure. We should not match with the income. Now what happens that last year closing stock we are bringing as a opening stock in the current year. Why we are showing opening stock on the debit side of trading account as part of the expenditure? Because that stock we are going to sell this year. So last year closing stock is included in the current year sales. Since that is recognizing as a income, revenue is recognized, the corresponding expense also should be matched. That's the reason we are showing opening stock in the trading account. Like I explained for the previous year how closing stock should be deducted from the cost, we are showing on the trading account credit side the current year closing stock. So you know that whenever an adjustment is given, every adjustment should come in two places, one on the debit side, one on the credit side. So closing stock is normally not the actual true value we estimate, we calculate. So that value we are showing both in balance sheet as a current asset and in the trading account on the credit side. The reason why we are showing on the trading account on the credit side is only as per the matching concept. Now let's move to another important concept called accrual concept. Many students have problem with understanding this concept. Let's take an example. Non-profit organization. You know that this is a very important chapter. People study in school level and also college and CA level. And like this, there are so many important, big, complex chapters are there in accounts. But if you see, those chapters are developed based on accrual concept. Okay, so here let's understand what do you mean by accrual concept, how this concept is actually governing the many chapters in accounts, what we supposed to do it. So let me give you a basic idea of the accrual concept. What happens, every business in real life, they do transactions both by way of cash transactions and also the credit transactions. Credit transactions are those transactions where we are not settling the payment immediately. Either the payment will happen in the future or receipt will happen in the future. So here both cash transactions and credit transactions are there. Now the question is whether business will record both cash transactions and credit transactions or only cash or only credit. This depends on what method of accounting they are following. There are two methods of accounting. One is cash basis, the other one is accrual basis. Cash basis is very simple, where we record only those expenses and income where the actual payment is done or actual receipt is done. So purely cash paid, purely cash receipts we record as expenses and income, whereas quite opposite to that, accrual concept. So this concept most of the business follow. In this concept, we record all expenses and income when it accrued and due. So two important terms, accrued and due. So here the payment done or receipt done is not criteria, it's not important, it's not relevant. What is important is whether an expense is accrued and due within the current accounting year. I used to ask students, why the salary payable, rent payable, interest receivable, all expenses outstanding, all incomes receivable, why these all came into our accounting process, who introduced. So people used to say salary payable is a personal account, representative personal account, like that, but nobody is connecting that with the accrual concept. So now I'm going to explain with an example accrual concept, how accrual concept is helping us to accounting and how it's playing a big role. Now let's take, every month I'm paying a rent of rupees 10,000. So every month means for full accounting year 12 months. So 1,20,000 rupees I have to pay, and this 1,20,000 is the current year rent expenses I have to record. If I follow cash basis, how many months I paid rent, to that extent only I will record. Say for example, in this current year I paid only for 10 months. Last 2 months, Feb and March, I'm not paid. So I will show in my books of accounts rent of rupees 1 lakh only, because I paid only 1 lakh. That is cash basis. Same way here, let's take now in accrual basis, where actually 12 months, every month 10,000. Here also I paid only up to 10 months only. So only 1 lakh I paid. Last 2 months rent I have not paid. Now here again, in accrual basis, will we record only 1 lakh as a rent expense, or total year 1,20,000 is a question mark. So as per accrual concept, here we are going to record the entire rent for the current year 1,20,000. Here last 2 months rent we have not paid. Already I told you in accrual concept, payment made or not is not the question mark. Here what is important is whether that rent accrued and due in that accounting year or not. Now let's everybody focus on what you mean by accrued and due. Accrue is nothing but liability to pay arises. It means the time to make the payment arises. To give an example, let's say I'm staying in a home on a rental basis. Every month I have to pay 10,000. So every month is month end. Now again, the owner will give us few more extra days on the following month to pay the rent. Say for example, every month rent I should pay in the next month before 5th. Now what happens? The moment the month end comes, 30th or 31st, the month end comes, it actually the rent is accrued. And within the 5 days of next month I have to pay, that is called due. So accrued and due means the liability to pay arises. If it is income, right to receive arises. Here you paid or received is not the relevant here. The moment it accrue and due within the accounting year, even if payment not made, even payment not received, we are eligible to record that expenses and income in our books. Now what will happen in the given example? In the 12 months, I paid only 10 months. So here rent account data to cash account since I paid. Whereas the last 2 months, I'm not paid, but the payment liability to make the payment arises. I have to pay. I'm liable. The time ends. It's accrued and due. Now what happens? Whether the payment made or not, but still I am eligible to record that as an expense. So still I debit rent account. But here the payment not made. So I can't put cash account. What I should do is this rent is still outstanding. It's still outstanding. I have not made the payment. This I am going to make in the future. Until then it will be outstanding. So rent account data to rent payable, rent outstanding, also called accrued rent. So this rent payable, anything is liable, anything is outstanding which we have to pay in the future is a liability. That's the reason all payables we will show in the balance sheet as a liability. Similarly, all receivables, interest receivable, account data to interest received. If received, your cash account will come, but not received, so receivable. All the receivables is our asset and it's a current asset we show in the balance sheet. So like this, because of accrual concept, all expenses payable, all incomes receivable will come in the balance sheet as a liabilities and assets. Accrual concept play a major role in many chapters, especially non-profit organizations and so many areas where we convert the cash transactions into credit transactions. We convert the transaction from cash basis to accrual basis, and then we record the expenses income in the main income and expenditure account and then profit and loss account. That is the importance of the accrual concept. Next concept is prudence concept of conservatism. So I used to ask students, why this provision is coming. You see so many provisions: provision for bad and doubtful debts, provision for discount on debtors, provision for discount on creditors, provision for taxation. Like that, there are so many provisions. Who introduced this provision? What is the difference between provision and actual liability? Why should we create provision? And why we are treating provision as a liability? And why we are deducting that in the profit? And why we are showing this in the balance sheet? So like that, so many questions I used to ask people. They just say provision we are creating because of we have to record the future losses, like that. See here, yes, there is a concept called prudence concept. Everything is happening based on the prudence concept. Now, a simple logic: if a business, whatever profit it earned, if it immediately takes that profit either by the owners or by the investors, if you completely takes away that profit, then if something happens in the future, you need some money to manage the business, some unexpected losses, some unexpected increase in expenses, additional expenses, then the business will be at danger level. So that's the reason, always to protect the business in order to bring the proper accounting and also keep the future in mind, they introduced a concept called prudence concept. So this concept tell us to be a conservative, think negatively, be safe, always keep something for the future. So this concept tells, if you anticipate, if you estimate, expect any losses in the future, possible losses in the future, then better estimate how much loss is going to happen in the future. We don't know exactly how much, but we should estimate how much it's going to come in the future. That amount better take away from the current year profit now itself and keep it for the future. Let me give you a best example. Today I sold goods on credit basis for rupees 50,000 rupees for 3 months. So I've given 3 months time for 50,000 rupees. There are so many chances. Either that debtor can repay the whole 50,000 rupees, or only a part he can pay and he say that balance he couldn't pay, or he can completely treat as bad debts and he can waive off the whole amount. That is a big loss for the business. So we have to be very careful. We have to understand the behavioral aspects of the customers and the other people from whom we have to receive the money, and then we have to see their past track record, how they are repaying the money. Based on that, we have to estimate, anticipate, if those people not pay any part of the amount, then that will be lost to us. How to treat that, how to keep that as a safeguard, like that we have to estimate, and then to that extent we have to treat that as a loss and create a provision. But this is not a current loss, this is not a current year loss, this is going to happen in the future. So to safeguard that, how much loss is going to come in the future, to that extent amount we will deduct from the current year profit by way of provision. So provision is nothing but a future loss we are treating in the current year and taking the money from the profit and transferring to a balance sheet and keep that to meet the future losses. But this concept is very strictly saying that don't recognize any unrealized gain. Nothing but you are anticipating in future I'm going to get this much profit, I'm going to get this much income. Don't do that. Best example, if the stock not sold this year, you shouldn't imagine that I'm going to sell the stock in the future, so I will treat this as income in the current year. That's the reason closing stock we don't treat as income, we show as a part of the deduction from the cost of the total goods. So that's the reason closing stock is unsold stock. We should not recognize any income on the closing stock. So prudence concept creates the provision for future expense and losses, not for future gains and profits. That's the reason we create so many provisions and deduct from the profit, and this provision is a liability and we show in the balance sheet either from the deduction of the corresponding assets or we show directly as a liability. So in this video, I just try to cover few important accounting concepts. In order to make it very short, I've explained the whole accounting concepts in a summarized way. Next video, I'm going to record few more accounting concepts and even more important practical implications in the accounting concepts. So everybody, please don't treat accounting concepts as a part of the theory. Please understand each and every accounting concepts what type of important implications it is creating in our accounting process. Thanks for watching. All the best.